We're standing by to bring you the decision and analysis. We have our senior business correspondent, Peter Ryan, who's down at the Reserve Bank. And with me in the studio is our finance reporter, David Chow. David, can I start with you first of all? What are you expecting?
Well, Ros, anything could happen, but the odds are overwhelmingly in favour of the Reserve Bank keeping rates on hold for the second month in a row. That's despite the Reserve Bank, in its most recent statements, maintaining what's called a rate hiking bias. So that means, well, just to give you an example, last month, the Reserve Bank board concluded its statement by saying further tightening of monetary policy should be expected, which is an alluding to rate hikes. And then in the minutes of that meeting, the RBA said the decision to pause last month should not be interpreted as an end to the rate hiking cycle. Now, I talked about market expectations. Markets are betting there's a 90% chance of rates being on hold, so that's almost certain according to them. While economists are a bit more divided, some economists from places like Commonwealth Bank expect the rates to actually rise today, but they're the outlier, I gotta say. And many economists are betting that rates have probably already peaked, or maybe one more rate hike to go in this rate hiking cycle. And people are already starting to talk about rate cuts next year. So the conversation is starting to change.
OK, well, let's go to Peter Ryan, who's outside the Reserve Bank in Sydney now, although the bank governor and executives, they're actually in Perth today, Peter, aren't they? So tell us more about what the Reserve Bank has to consider when making this month's decision. What would make it pause? What would make it push rates up again?
Well, good afternoon, Ros. Really, it would be a shock or a big surprise if the Reserve Bank lifted the cash rate above 3.6% this afternoon. And that's because we've had a fall in inflation, softer inflation, coming down from 7.8% in the quarter to 7%, which is a sign that those 10 consecutive rate rises are working, even though it's a lagging indicator. Also, in previous weeks, Reserve Bank Governor Philip Lowe has indicated that the Reserve Bank Board would probably be prepared to tolerate inflation above the 2 to 3% target as long as they saw evidence that it was falling. And so we do have that. But as David Chow mentioned there, money markets see a near certainty that there's going to be a pause following up on the April decision, although it should be said that that April decision to pause was a very close call, as we saw in the minutes. And no doubt they might be meeting in Perth, but there'd be a lot of debate over whether or not one more rate hike is needed, just really to use that blunt instrument one more time to make sure that inflation really is being pushed lower.
Some economists, though, are talking about a wild card in all of this, and that is the faster than expected recovery in net migration. That's expected to expand the population by 400,000 people this year, and that's going to be inflationary, surely, isn't it?
Yes, that could be inflationary. The other thing that the Reserve Bank Board will be watching very closely, not today, but next week, will be the federal budget, just to make sure that Jim Chalmers keeps to his word to ensure that any spending is targeted towards households in the most need and not a major cash splash, which could be a bit of a temptation, given that there are some expectations that the deficit will become significantly lower, maybe even fall into a very small surplus by the end of the year, which actually makes it harder for the government to deliver budget austerity or budget repair. So there'll be a lot of focus just on what happens not just with monetary policy from the Reserve Bank Board, but that fiscal policy that we get from Canberra.
We're just waiting for the Reserve to make the announcement about interest rates. But house prices and rents, we had evidence that they're on the rise. That came out yesterday. We do have an announcement, David.
Well, Ros, the cash rate has increased by 1/4 of a percentage point, which is the low probability outcome happening. So it turns out money markets were wrong, and I guess some economists turned out to be right. So that takes the cash rate now up to 3.85%. It's, I guess, a very surprising outcome of this meeting. Markets were attaching a very low probability of this happening, and it has indeed happened. So I'm going to jump to the final paragraph of the statement because that will offer some clues on why the RBA made this surprise call. So in this statement, Reserve Bank Governor Lowe says some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend upon how the economy and inflation evolves. So the board will continue to pay close attention to developments in the global economy, trends in household spending, and the outlook for inflation and the labour market. And the board remains resolute in its determination to return inflation to target and will do whatever is necessary to achieve that. So, look, I must say I'm pretty surprised by that decision as well, considering money markets are betting there was a 90% chance it would not happen. And I guess to get some further analysis, let's bring in our guest, one of these experts, Alan Oster, who is the chief economist of NAB. So, Alan, were you surprised by this decision?
Sure was. I was like you. I basically thought inflation's coming down. I think there's a risk that tomorrow we'll see retail sales with a negative in front of it. And I just thought the RBA, okay, maybe they were 3.6 is probably not high enough. And at some stage they might think of going again. But our sort of idea was that as they delay, the longer they delay, the higher the chances that they're done. I think they're probably done now anyway. But that's a big surprise to, I think, just about everybody.
Yeah, so even though a lot of economists think interest rates are at their peak, as you say, or near their peak, another rate hike this year might not be totally ruled out. It very much depends on what data comes out about the economy. I mean, let's say if there were another rate hike in the months to come, do you think households would be able to withstand more rate increases?
Well, I think they can withstand them, but their problem will be that they will reduce their spending. And so that will generate an even worse economic outcome than what we're currently looking at. And based on where we were, we're seeing essentially the economy flatlining in the second half of this year. So I think if you keep going, yes, you'll fix inflation, but you might also fix the economy, if I can put it that way. And so I think you just need to be fairly careful.
And Alan, I'm curious about one thing. Yesterday, some figures on the property market came out and it showed that house prices are on their way up again, according to that CoreLogic data.
Yeah.
So is the wealth effect something the RBA may be concerned about, especially if house prices continue their recovery? You know, people might feel they're better off economically and they might spend more, which might make it harder for the Reserve Bank to bring inflation down.
That's possible, but let's face it, it's mainly a Sydney thing. I think they're up over 1% in Sydney and across Australia, 0.5. So, yes, there is a wealth effect associated with that, but there's also a very direct interest rate effect. And so that's much bigger than what the wealth effect. So the nice news is that, you know, things are probably bottoming out, but, you know, the fact that the economy is still going to slow, I think, is an issue. And, you know, once again, the Reserve Bank's made it very difficult for us all to understand what the hell they're talking about, to be brutally honest.
So, Alan, I know you're still digesting this just like I am. So I hate to put you on the spot, but does this surprise decision to lift interest rates to 3.85% cause you or your team to change your forecast? Like, do you think 3.85% is now the peak of interest rate in Australia, or do you think there could be further to go?
I think it's probably 3.85 is the peak. Whatever they do, they'll be cutting back to 3% next year. So, you know, if they go a bit higher, they'll just have to cut a bit more next year. And so we've got the rate cuts in the middle of next year. And who knows, they may come a bit earlier than that if you keep going up. So I think ultimately you've got to fine-tune both inflation, but also you've got to see what the economy is doing. And the rate of increase in rates is really quite strong by historical standards.
Yeah, I find that very interesting that you and other economists are forecasting there could be rate cuts next year. I mean, if that were to happen, does that suggest the economy isn't doing too well and that Reserve Bank needs to stimulate the economy in some way?
Well, I think it needs to get out of well, based on our forecasts, we expect the economy to basically really struggle. Now, that's probably putting a bit of a downside risk to that. But ultimately, you know, you don't want restrictive policy at a time when the economy is struggling. And so we would expect to see unemployment slowly edged up to, say, 4, which is not terrible, by the end of this year, but probably on its way to 4 3/4 the following year. And 3 roughly is neutral, and 3.85 is not neutral. So I think that's the sort of thing that they'll be looking at.
And Alan, I've got one more question for you. So given the Reserve Bank lifted rates today, and that's generally not good for property prices, I mean, what's your forecast for the property market? Are you expecting a continued recovery in prices, or do you think there's some further downside in property prices?
We have a very small downside. So we changed about a month or so ago from -11 this year to something like -4, which would imply, a small fall in the next month or so. But it really depends on what's happening to unemployment, because the other thing that people are not talking about is that the turnover is down about 20%. So if people get into an awkward situation where they have to sell, that might put property markets down a touch. But I think broadly, you'd say that they're sort of flattening out now and then up a little bit over the course of the next year.
Well, Alan Oster, thank you very much for your insights. Really appreciate you taking the time.
Thank you.
So that was the Chief Economist of NAB, Alan Oster, giving his analysis on the Reserve Bank's decision to lift interest rates by 1/4 of a percentage point, which takes it to now 3.85%. And it's worthwhile, I guess, playing these graphics I've prepared, which might help explain why the Reserve Bank made its decision. So consider that 53,000 jobs were added to the economy in March. The unemployment rate's at 3.5%, which is a 50-year low. And also, annualised inflation fell to 7% in the March quarter. So even though it's a big fall compared to the December quarter, it's still, I guess, in the Reserve Bank's view, at a very unacceptably high level. Though the Reserve Bank, Ros, has said that it's willing to tolerate high inflation for a while, and it expects inflation to fall back to maybe 3%, which is an acceptable range within 2 years.
Alan Oster, very surprised, wasn't he?
Yeah.
Really taken aback by that.
Me too.
OK, David, for now, thank you. Let's go to Peter Ryan, who's at the Reserve, our senior business correspondent there. So, Peter, you've been poring over this statement from the Reserve Bank. What's in there that perhaps will show that they were more worried than we thought about inflation?
Well, the Reserve Bank board has been really reinforcing their concerns about inflation, saying that they are resolute that inflation needs to be brought under control, and unless they use that rates instrument once again, as they have today, inflation could become ingrained in the psyche of Australians. In other words, inflation psychology, where people just work it into their budgets and expect that inflation will remain high. So they've had to take that rate sledgehammer out once again. And when you think about it, last May, or before the meeting in May last year, the cash rate was just 0.1%. Now it's gone up by 3.75 percentage points. And so there would have been quite a fierce debate, I would imagine, within the RBA meeting today about just how far they think they can use that hammer on the Australian economy, given that so many borrowers and businesses are doing it pretty tough with such a dramatic rise in their repayments for loans and mortgages. And as Alan Oster was saying, the Reserve Bank is pushing the Australian economy as far as it possibly can, as close as it possibly can to a possible recession, to the point where they will have to be in the position to dramatically cut interest rates next year to breathe life into the economy. And also making the point, in addition to inflation still being very high, acknowledging that it's fallen annualised to 7%. It's still high, and it's fueling wages growth. And we do have the jobless rate at a 50-year low of 3.5%. So they are big concerns for the Reserve Bank, and unfortunately some pain for borrowers. But if you're anyone with a bank deposit, you might be feeling a little bit chuffed this afternoon.
This surely, though, has to be the last rate rise in this cycle.
You'd have to imagine 3.85% is pretty close to the top of the range, and as Alan Oster said just then, that they may well be right at the end of this rate hiking strategy, because they would be weighing up simply how far can we push Australian households and businesses in slowing the economy. What else do we have to do to push inflation down? Because even having fallen to 7% annualised, it's still incredibly high, still well above the 2 to 3% target band. And while Philip Lowe, the RBA governor, said recently that they would be tolerating inflation above that band. They're not going to be tolerating it if it's still sitting at 7% over the next few months. So dramatic action needed.
Might this lead to some tweaks to the federal budget next week? What do you think, Peter?
Possibly, but it would probably make Jim Chalmers and Anthony Albanese even more resolute to ensure that whatever they push out in that budget will be targeted relief to vulnerable households, no cash splash whatsoever, even though we had some of the best commodities prices we've seen recently and they're underwriting the budget. And there's strangely, when you consider the pandemic gloom of deficits as far as the eye can see, and at one point debt of $1 trillion, which is now almost half to a still very high $566 billion, there could be a temptation to not go as hard as they need to in that necessary budget repair. So the Reserve Bank Board will be watching that very closely. And one more point is that this is the first RBA board meeting since the RBA review came down. And as a result, in meetings probably from next year, we'll be expecting to have a press conference with the RBA Governor, Philip Lowe, assuming he's still in the role, and more communication and transparency as recommended in the RBA review.
That's right, and fewer meetings as well, Peter, I understand.
Yeah, fewer meetings, down from 11 to 8. So I'll be down here at Martin Place 3 fewer times. But we'll still be reporting this in a different fashion. I think one more point is that I guess in some ways by doing these regular crosses on ABC News Channel, we in some ways have been contributing to the interest that borrowers have of all levels in interest rate decisions because of the monthly decisions, with the exception of January. Whereas in a place like the United States, mortgages are fixed in most cases for 30 years, so there's less attention on those monthly readings. So perhaps fewer meetings might provide more substance and less theatre, I suppose, about interest rate decisions.
Back to you finally then, David. How have the markets responded to this surprise move?
Well, it's been quite an extraordinary reaction, I've got to say, Ros. Starting with currency markets, hopefully the slides have caught up to me. Let's see, they have not yet, but I can tell you that, well, this shows you what the Aussie dollar was doing before the RBA decision. It was buying about 66.3 US cents. Right now, the Aussie dollar is pushing closer to 67 US cents after an almost 1% jump. And the Aussie dollar is higher against major currencies too. It's jumped by nearly 1% against the US dollar, the euro, the yen, and the British pound. So I guess the dollar had been falling before this decision. So I guess with interest rates higher than expected, I guess traders have thought, okay, the Aussie dollar is a safe way to put your money for a higher return. So now let's look at the stock market. It probably hasn't caught up to me. So look, yes, I think it has. So the Australian share market was pretty much flat before the decision. Right now, it's a pretty hefty fall. The ASX 200 down by 0.8%, and every sector on the stock market is now in the red. So given the magnitude of these, the falls on the share market and the big rise in the Aussie dollar, it shows markets were surprised by the outcome of the RBA rate hike.
OK, well, let's wrap things up there. Just a final reminder, the Reserve Bank has surprised everyone and raised interest rates by 0.25%, pushing the cash rate up to 3.85%. Thanks to finance reporter David Chow and to senior business correspondent Peter Ryan at the Reserve Bank in Sydney. Thanks to you both.